Hello everyone. What a wild ride the second quarter of 2025 has been. Investors were thrown into a whirlwind of volatility driven by tariff tensions and escalating conflict in the Middle East. It's been a test of nerves, but also a time of opportunity. That's what I'd like to focus on today. We've seen some of the sharpest market swings in recent years, both dramatic declines and record-breaking highs. In early April, markets were shaken by President Trump's announcement of sweeping reciprocal tariffs. This went far beyond what investors had anticipated. These weren't targeted measures, they applied across the board with every country hit by at least a 10% tariff. The EU, Japan, and China faced even steeper penalties. The reaction was immediate and severe. Fears of a US recession and a broader global slowdown triggered a sharp sell-off. The S&P 500 tumbled more than 10% in just 2 days, marking its fifth largest two-day decline since World War II. For context, the only historical rivals were during Black Monday in 1987, the depths of the global financial crisis, and the initial pandemic shock. But what followed was equally dramatic. In response to the market turmoil, the US administration quickly softened its stance, pausing the tariffs for 90 days and laying the groundwork for a trade agreement with China. Markets roared back. We saw one of the strongest single-day rallies since 2008, followed by one of the fastest recoveries in the S&P 500 history. As the chart here shows, 2025 in dark green stands out as one of the swiftest rebounds from a 15+ decline, surpassing even the sharp recoveries seen in 2020 and 1998. By the end of June, the S&P 500 had not only erased its losses, it had climbed to a new record high, finishing the quarter up nearly 11%. While all this was unfolding, we were anything but passive. Our portfolios are layered with diversification across asset classes, geographies, styles, and strategies. That gives us the flexibility to manage risk while positioning for opportunity. For example, against a backdrop of rising uncertainty, particularly around Trump's tariffs and the potential to slow economic growth, we took a more cautious stance. In mid-March, just weeks before Liberation Day, we reduced our equity exposure in both the US and Europe, raising cash. When markets sold off sharply, we were well positioned. And just as importantly, we had dry powder ready to deploy into the weakness. We reinitiated positions particularly closer to home in European equities, where we continue to find attractive valuations and solid fundamentals. Inflation is close to target, interest rates are trending lower, and governments are spending on infrastructure, defense, and other growth-supportive projects. That's lifting both consumer and business confidence. So while we de-risked, we didn't disengage. We stayed nimble and selective. Another trade worth highlighting, having raised cash in March, we initiated a new position in the US tech-heavy Nasdaq 100 during the market turmoil in April. At the time, the Nasdaq was down around 20% year to date, but we believed much of the fear was overdone. We saw the index as relatively insulated from the tariff risks, largely because many of its biggest companies operate in software and digital services sectors, less directly exposed to tariffs on physical goods. The trade played out well. The ETF rebounded 13% within weeks, and we exited the position by the end of April. It's not typically our style to move in and out so quickly, but these were unusual circumstances. The swift recovery delivered a strong return in such a short space of time, and we were happy to lock in those gains. Another dominant theme this year has been the sharp shift in sentiment away from the US dollar. In fact, it's having its worst start to a year since 1973. On the chart here, we've traced the path of the dollar going all the way back to 2000. The shaded light green area shows the typical trading range. But look at 2025. The dark green line shows the 2025 trajectory is well below the lower bound, highlighting just how extreme the move has been. The dollar's already fallen more than 10% in the first half of the year, underperforming every other year in the 21st century. So what's driving the sell-off? Well, Donald Trump's unpredictable trade policy has created a lot of uncertainty. And also, rising government debt levels in the US are really starting to chip away at investor confidence in the dollar. Fortunately, within our well-balanced portfolio, we have areas that help hedge against dollar weakness. One area that has particularly benefited is our exposure to emerging market bonds. These typically perform well when the dollar is weaker. Their debt becomes easier to service and they become more attractive to global investors looking for higher yield and diversification. And just to finish off with another shining bright hedge we hold in our portfolios, gold. It's had a remarkable run in the first half of 2025, surging to new record highs. Escalating geopolitical tensions, including conflict in the Middle East, ongoing trade disputes, and unpredictable US policy have made gold increasingly attractive to investors seeking stability in uncertain times. So to wrap up, Q2 brought its share of shocks, volatility, and attention-grabbing headlines. But throughout, we remained focused, disciplined in our approach, and committed to our investment process. We made active calls, reducing risk when it made sense, leaning into opportunity when it appeared, and always keeping your long-term goals at the heart of our decisions. This is precisely why we build portfolios the way we do: global, multi-asset, and thoughtfully diversified, to help you stay on course no matter the noise. Thank you.